Sorry, everyone. I could not get my system to work today. The device restart. Okay. Can you hear me?
Yes, we can hear you.
Okay. I'm sorry. I could not get my system to work. Hey, Michael, how are you today?
I'm doing great. How about yourself?
I'm good. I'm good. Thank you for joining us, man. Keisha. Hey, we still good for Tuesday? I guess so. You're muted. I see you scrubbing and saying bless. Oh, you working. Is that something you making right now? Oh, I see your creation. Okay, nice. Nice. Get the get the money, girl. Get the money. So both of the coaches are out tonight, Renee and Rosie. Rosie had a family emergency and Renee is doing a double time on her shift. So um it's just us and whoever joins the meeting. So I'm going to give everybody a few more moments before they join. So I
Should
really
I
I really like your book,
Sabotage?
man.
Should I? What was that?
I really like your book.
Oh, you read it?
Mhm.
It's really easy read, right? Really easy to read. It's packed with knowledge, straight to the point.
Mhm.
Yeah. So since there's not much people on going to be much people on the call today, should I do my little guest speak next week?
It's up to you, man. It is recorded, so whatever you want to do, if you want
Okay.
to go ahead and do it, we always put it up on for our people. Are you doing a PowerPoint or are you just share?
Yeah, it'll be PowerPoint with interaction. So I
Okay,
prefer coming back next week and
okay,
engaging with the crowd more.
okay.
But
That's fine.
I'll be here. I'll be here taking notes, listening on.
Okay, let's see how many more people join us then. Then we'll go from there. Um,
So, what were some key takeaways that
yeah.
that you enjoyed about the book?
Well, it's basically how you got started, man. You know, everybody always have their own journey, and that's really intriguing always to me. Ah, shoot, sorry here. Trying to get my systems up, man. My system wants to run stupid today. So what is your job that you do?
Financial advisor.
Okay. Now, do you find that to be profitable?
Yes, very profitable.
But how hard is it?
Not hard at all.
Oh,
It's
really?
we're changing the financial advisor game. We have a system that we've been going by for over the last 30 years, and it's been transitioning and revolutionizing the financial world. So we're not your typical older gentleman. Oh, I can only sit with you unless you have $250,000 in assets. No, we're
Hmm.
financial educators, but we have our financial advisor license, such as our securities licenses and our health and life license, a disability license, and such forth.
Okay. So are you pushing people towards what kind of investment do you push them towards now?
They tell me what they want. I first educate them, and then they tell. I'm not here to sell anything. That's why I'm not here to give a advice or recommendations based off what I'm wanting to do for them. It's in the best interest of the person. You know what I mean? We have to be fiduciary about this.
Okay.
So I first lead with education, and then after that education, they get to decide. Hey, I want my money to grow in this account, or I want it to be a tax-free investment. And then I can show them various different ways. I can show option A, option B, option C, and they get to decide what they want to do with the money.
Makes sense. Okay. That makes sense. I'm sorry, y'all. I'm sure my systems are not wanting to cooperate with me today. It's like one moment, y'all. That's what you have. This is what you get when you have too many computer systems. Okay, let's try this one here. Ba-da-ba-ba. All right. Sorry, I'm going to disconnect real fast and try another port. Hmm. I don't know where this thing goes to. All right, I think I got half of it done. Maybe not. Sorry, can y'all hear me? Are we still there?
Yes, we can hear you.
Okay, I'm sorry. I'm trying to get the system together, man. This thing does not want to cooperate with me today. What in the world is happening? Okay. Well, we're only using two screens tonight. I can't get this thing to work. Did I? No, I lost it. Oh, shoot. All right, going back to the other way. Sorry, one more time. Woo! Any other day it wants to work, now it don't want to work for me. All right, so we're only gonna use two screens. Sorry about that, y'all. Um, so we were wanting more people on the night on the call tonight. So Michael's going to revisit next week. So luckily I put together a PowerPoint for us. So I'm gonna share my screen here and see if we can get started here. Renee and Rosie are is out tonight. They both had Renee's working, Rosie had a family situation pop up.
Have you spoken to Armando or Rochelle?
Not today. We spoke earlier about a property, but that was it. I haven't spoke to them today. They normally end up jumping between two different meetings. So we end up catching them sometime, and then we always run into. All right, sorry, here you go. I'm trying to get my stuff together, y'all. I was, believe it or not, I've been on this thing forever and it's still not working for me. All right, everybody can see my screen?
Yes.
Okay. I'm like, can you see my screen? All right. So tonight I want to talk about the pros and cons of using a credit card to invest in real estate. We all know that our method, especially for a lot of people that come into our program, we don't have money reserved or finances that can actually be utilized to purchase an investment property. Most of our money, we're living paycheck to paycheck. Money goes in, money goes out. So then we have to figure out creative ways to actually buy real estate. So before we create that passive income, my way has always been credit cards. But there are several different other ways that you can actually utilize. Um, you know, we all know you can actually go to the bank and get an actual mortgage to invest in real estate. You can actually, sorry, I'm trying to get the screen up here. My day is going bad here. You can actually get a mortgage, go to the bank, get a mortgage for investment property. You can get partners to invest in investment properties. You can do a couple of deals as a wholesaler. There's several ways that you can actually get into real estate, right? But one way that I always found is that you can actually hold and have control of your real estate investments and journey is credit cards, which is a very creative way. Okay. Now, the good thing with using a credit card, there's two things that you can use. If you buy a property on a personal level, and I'm going to say this now, if you buy a property on a personal level and you don't have that property over 2 years, so you're fixing and flipping, you're going to have what is called capital gains on the personal level. You have to do a 1031 exchange. It's called 1031 exchange after you get those proceeds. If not, you're going to be paying taxes on that money. So you want to roll that money to another investment, continuously repeat. However, most of the people on this call, we're trying to set you up to make sure you have businesses. So when you have a business, you don't have to pay that 1031 exchange because your business is to generate income. That's your business. So you can have a fix and flip property, but you have to know the tax liability obligation and how to set up your business properly so you can get those deferments. Because some people, even though you're filing that, they are deferments for businesses. Sorry, Renee's trying to contact me. Yes, Renee.
Not to me?
Yes, we're on.
Oh my God, so what's, can you send the text? Send me the text, I can't get on, they have me waiting.
Okay, I'm doing it now.
Okay, thank you.
Sorry, y'all. Give me one moment here. Let me get Renee in here.
I sent it to her, Sabor.
Okay, thank you. Thank you. All right, so anyways, I apologize. There she goes. She getting in now. Don't know what that was about. Thank you for joining us, Renee and Coach Rosie. I see y'all there.
Yeah, I can't stay long. I just hopped on for a hot minute.
Okay. Well, with tonight, we're just going over the pros and cons of credit card investing. Michael's going to speak next week when we get more people. But I just wanted to go over tonight, the pros and cons of using credit cards. I was just talking about on the personal level, if you buy a property, you have to do a 1031 exchange. If you're going to continuously fix and, rinse and repeat that process. On a business, of course, you don't have to pay, do the 1031 exchange because that is your job. That's the job of your business, is to create that income that way. But you do have to file those taxes. There are exemptions that you have not have to pay that money. Of course, your business is going to pay money depending how you set your business up. We always tell you to file as an LLC and then get your business as an LLC, but file as an S corp. That way you can avoid a lot of the tax obligations as being an LLC. But anyways, from there, I just want to talk about, the pros and cons. Y'all know our debt weapon declaration here. So I'm not going to go over, I'm going to speed through this tonight so I won't hold up everybody's time. But I'm going to read it. You don't have to repeat after me. So this is the debt weapon declaration. This is my life. I declare today my mindset has changed. I'm clear about my path. I walk in the understanding of my finances. I control my spending habits. I am not a consumer. I am an investor. My money works for me. I live in abundance. All things are possible to me because I believe. I am financially sexy and I won't give up. So we have Michael. We know that he's a financial advisor, so it's really good to have him on the call when we're talking about real estate and how we invest in real estate. Everybody, again, my go-to way. My go-to way is to I'm sorry, I'm dark as I don't know what I turned the light on. My go-to way is using credit cards. Some people go-to way is going to be using HELOCs. There's some people that's going to be using all different type of creative ways. Again, we're talking about creative ways because as you're going to see in my slides, creative ways of financing goes to those little small people, little small investors that don't have the funds, that's living paycheck to paycheck, want to create passive income. Even though I have the funds now, I still use credit cards because I just love the cashback rewards. I love the method. I love not having to pay the closing costs. I love not having to pay the fees to a closing agent. I just love the way that it works. But however, it takes one important thing, and we always talk about this. You have to learn how to be comfortable with being uncomfortable. When you're putting 40, 50, 60, $70,000 on a credit card and you're waiting for a return, it can get scary. It can get scary. So you have to learn how to be comfortable with being uncomfortable, right? So anyways, we all know that real estate, it continues to grow all over in today's market, despite the rising interest rates and crazy housing prices. In 2022, over 20% of all the houses that was purchased were purchased as investment properties. This is the highest rate since 1999. We all know about in 2008 when the housing market crashed because they had so many investment properties and things like that. So since in 1999, it actually started increasing again. I'm sorry, since after 2008, after the market crash, the investment pool, people looking for alternate ways to diversify their portfolio, has increased. So most people are doing rentals, right? So and it's not surprising that the growth, is attributed to new and small investors like us that's focusing on, starter homes, in markets where they can, command high rents. However, our goal is a little bit different. We're trying to teach you how to do seller financing. We want you to teach you how to be the bank. The reason why we want you to stay away from rentals. Remember, when you have a rental, say you make 5,000 that year from that rental property, that person leases only up, it's only a 1 year lease. That person moves out. You get a contract to go in. He say, "Oh, you owe me 12K, to do this work." Did you make any money? You just had a setback. However, if I'm the bank, these people buying the property from me and they're paying me as their mortgage company, they default. I take back the property. They default. We go through a foreclosure. They default, whatever. I don't lose. Even if I sell that mortgage loan to another investor, I just recoup my money even that faster. So I'm never losing as being the bank. So again, you have to think about it. Why do banks have so many mortgages? So again, this is why we're trying to teach you to seller financing, stay away from the high demand or the high competition in having rental properties. Anyways, market conditions set aside, the goal of real estate investing is to make a profit. We all want to make money. But however, you have to choose the financing to purchase the property and to make sure your role is profitable, right? Again, some people can go out and get a mortgage and they can be profitable. I've known investors to come into the game and they get a mortgage for the investment property. Their mindset of thought is they want to pay the banks off as fast as possible. So they'll take a 5 or 10-year mortgage on the investment property. That is absurd to me because you're not cash flowing, because their goal is to pay that property off fast, right? That means they're going to be paying more money in that property. I mean, they're going to be paying more money to the banks and not cash flowing anything. My goal, it was always the cash flow. So I'll go to the bank and take a 30-year mortgage to get the lower payment, even though I'm going to be paying more interest, so-called over time. I'll take the lower mortgage, $200, $300 a month instead of paying $900 a month. I'll take a $200-$300 a month payment, and then I'll cash flow on that property by doing a seller finance deal where I'm making $1,200 to $1,500 a month. That makes sense, right? Now I'm cash flowing instead of losing money. I'm actually gaining money. But, again, the way we teach you in this strategy, even though I'm taking a 30-year mortgage, I'll have that 30-year mortgage paid off in 7 years. So the banks really don't make any money off me as far as interest wise. All right. So anyways, 42% of investors, they like to take out mortgages, which is normally what we were taught when we first came into the game, especially, you were taught to either wholesale, wholesale, or get a rental property and get a mortgage on that rental property, right? But, for investors like us that don't have the cash flow, who wants to keep their cash flow reserved, for those seeking, alternate ways instead of getting a mortgage, they try to find creative options. And my option that I'll talk about and the way we teach you in this program is using a credit card, right? So yes, you can use a credit card to invest in real estate, to purchase a property of a low price property outright, covering the cost of renovations. The credit card can also provide investors with an alternate a creative way of financing or tapping into your home equity without tapping into your home equity. But the question is it a good idea? Are you comfortable being uncomfortable? You know what I mean? So a lot of times before you think, go out and buy a property with a credit card, before you incorporate the plastic into your investment strategy, be sure, as we always teach you, especially those in our investment course, to weigh the pros and cons of having that property. So tonight, I just want to go over some of the pros and cons that I've looked at and gone through over the years that myself, and maybe some of you guys that's on the call that's doing investment properties now in the investment group, you can actually, it may be triggered, or, some of these things that you've seen or are thinking. So the pros of using a credit card to invest in real estate, it's a faster buying process. Using a credit card, you can streamline the buying process, of course, the renovation process. No lenders or mortgage approvals are needed to make deals. So that's instant financing. a quicker closing time and less paperwork to complete, and no potential financing delays. The reason why we say financing delays, anybody ever heard of a shoot, I can't think of it now, a 1003 form? 1003 form is when you fill out a mortgage application, it goes to the underwriter. That underwriter job is not to qualify you. The underwriter job is to find a default in all of your paperwork. That could be income, that could be credit score, whatever. That's why they tell you when you apply for a mortgage, do not apply for new loans or credit cards. And while you're in the process, wait till after you close to do these things, because the underwriter is going back and forth in your history. They're trying to find a reason not to give you the loan. They're trying to find something wrong. So these things I'm talking about can actually cause delays in your financing. You know, I helped somebody get their credit right, and they were getting ready to get an investment property and another in their own primary property. They got excited because they already had got a pre-approval for their property. They still have to do that 30-day closing. They went and bought new stuff. You know, even our investment group, we had the guy, he qualified, he got get ready to closing. He ended up spending his money on new refrigerators, windows, and driveways and all the stuff. So he didn't have the money for closing. Luckily, he came up with it. But these are the things. But on a with a bank, even though you may have that cash reserve, they're looking at this stuff. They're going to see that you pulled a new credit card. They're going to see that you went from a, you know, 30% of your utilization up to 50% because you went and started buying all the stuff. Now that stuff can push you back. Now they're going to tell you have to pay that off in order for you to finish qualifying, you know, those types of things. So those type of things can delay. So, and again, anyways, a credit card can actually go alleviate all that because you don't have to go through a lender, right? Next is that a credit card, you have fewer closing costs. You avoid paying the closing costs that's associated with the mortgage, such as application fees, origination fees, appraisal, escrows. Um, Trying to think. You know, anyway, I can't think of. It's so many different fees that they can hit you with, and also you can end up paying extra taxes and insurance for transfer fees, deeds, and all that stuff like that. So with a credit card, you actually eliminate a lot of the fees associated with getting a mortgage. Also, it can close the refinance gap. You know, so a lot of lenders are giving you, especially on investment property, they're going to give you if you go to a hard money lender or a mortgage, they'll say they'll give you a loan to value. They're not going to purchase the whole property for you. They'll do maybe, you know, I put it here 97% of the traditional financing, right? They'll do a loan to value, or they'll cover it, but because it's an investment property, they won't give you a 3% down or or 20% down on conventional. You're actually gonna have to come up with 25% down for that investment property when you get a mortgage. Okay, so with the credit card, again, it alleviates those refinancing gaps and stuff like that, so you don't have to come up with a lot of money. Again, credit cards, can finance up to 100% of that purchase of that property, as long as you have that credit limit. Another one is potential lower interest rate. If your credit card has a zero or low interest rate promotion rate, you can come out ahead of traditional financing, right? This can provide significant savings, especially when compared with using cash out refinance or home equity loans for renovation costs. Instead of paying interest on the total of the renovations, you can actually purchase supplies and material at a no to low zero interest rate. So, and I'm writing these things out in my head, but basically what this means is that when I use a credit card and I have an introductory rate, we all have credit card offers when we first get our credit cards. A lot of us, the ones that we tell you to get, right? You can actually utilize that zero or zero interest rate for 18 months, zero interest rate for 20, 12 months, whatever, and purchase that property. Now all you have to do is pay on the principal balance of that credit card for 12 months. You're free. Our goal, again, for seller financing, the way we do our deals, we hold our properties no more than 7 months max. And that is doing the rehab, getting somebody in that property, and then waiting 3 months of payments before we can sell that mortgage loan. guess what? All I did was just pay my principal money that I took off there. I didn't have to pay any interest on that money off my credit card. Make sense? All right. Um, lastly, is that you can avoid, using your home equity. Using a credit card instead of a cash out refinance loan or home equity line of credit, or HELOC. Avoid the risk of, trying to renovate or purchase an asset. A lot of people, I really will recommend somebody to use a home equity line of credit, because the home equity line of credit to us is just like a credit card. But for a consumer, most people, they're going to go and do a home equity line of credit and or or refinance cash out home loan, and now they have a new loan. Now they have new debt that they have to be obligated to pay. And again, if they're a consumer, they don't know how to manage or handle those. Again, we're talking on the investment level, and I can't stress to y'all how important it is to think and act on the investment level. All right, so the cons of using a credit card to invest in real estate. This is my biggest one. High risk factors. So the most significant drawback of using a credit card to invest is risk. You could potentially overexert yourself, meaning you should you may have something that comes up that affects your ability to make that payment. If you're already living paycheck to paycheck, right, and you take a credit card in to go buy an investment property, and that investment property does not start generating you income immediately, now you have just created a new debt. So that can be a very high potential risk. So you have to weigh the pros and cons of how fast and or how you can comfortably make those payments. Again, when you're doing, we know when you first take out buy a property with a credit card, we always want you to velocity bank that credit card back. However, there are times when you actually have to just make the minimum payment. Make the minimum payment, satisfy the minimum payment while you wait for the investment property to start generating cash flow is actually okay. Yeah, I'm just going to say it's okay, but we always want you to velocity bank that credit card back to get that credit card back to zero so you can go on to your next property. However, if being high potential, if you're already living paycheck to paycheck, you use a credit card to buy a property, and then that property is not cash flowing, it is okay to make the minimum payment until that property start cash flowing for you. Another one is going, high payments. Your credit card payment will be significantly higher than a mortgage, amortized over 15 or 30 years. So like on a 15 to 30-year mortgage, you think if we buy a property for $100,000, right? You're on a mortgage of that size for 30 years, depending on your interest rate. I'm just saying past average interest rate of 5%. Interest rates are almost 9% now. I don't know if y'all know that now, but interest rates say 5%. That's going to give you a monthly payment about $550. If I take that same property on a credit card, it's going to cost me probably about $1,100 a month. So, it's going to be a little bit more expensive on the credit card. But again, our goal is to pay off the credit card back to zero fast by using our cash flow. That way you pay very, very less in interest. So, next one is that, some credit card companies can, stop the credit card limits or lower your credit card limits or stop the card just altogether because the company is going through you know a shift. The company's doing something, they start cutting people credit limits or cutting people off. So that could be a potential drawback to actually using a credit card to purchase it. I never had it happen to me. I'm not sure if anybody on call that's investing actually had some credit card company cut off a card while they actually have access. Funds already spent. I don't know. I never heard of it. I've had credit cards come to me and lower my limits for the simple fact I don't use the credit card. They'll come, they say, you haven't utilized this credit card in, 24 months. So we took you down from 50,000 to 20,000 or something like that. So that's normal. Um, Anybody had that before? Had that happen to them? This is how many credit cards I have sitting on the side that I don't even use. And so this is like a stack of credit cards I don't even have on the side. So they do it. I get it all the time. So they'll lower my limits, but it doesn't matter because I have so much credit that it doesn't really phase me. And most of the cards they do that, I see them do that on, it's going to be Capital One, for sure. I never Discover. So Discover did that to me once, but what happened was they gave me a credit line increase, but at the same time I asked for a credit line increase. So they tripled uh my line of credit. So they came back months later and said that at the same time that they were increasing me, I asked for a credit line increase. So I was double, which I knew it when they made a mistake. I was like, oh shoot. So but they came back and took it back. So they had gave me I altogether had 75. They ended up giving me 50 of that. Yeah, so they took 25 off of it. Um
That's
anyways,
good.
yeah.
Um, I think I told you, but yeah, that happened to me. I had one of those fintech cards, credit cards. No hard inquiry, fintech, like business credit cards. That happened to me. They happened to. It was a disagreement between the fintech company and the bank lender,
Hmm.
and so yeah, but that that was beyond the customers, but they decided to pretty much cut that whole line. So anybody who had that card, um, yo, and they they did it before they even notified customers. So like a lot of people lost lines of credit, for like business related expenses, me included. So yeah, that's happened to me. Just then
Yeah, another thing too is with fintech companies, if y'all don't know what a fintech company is, they are the new basically new companies that don't use credit to look at giving you lines of credit. If you have a business, they actually tap into your business account and see how much income your business is generating and give you your credit line based off that. So they'll have a criteria that most people buy. So they'll say you have to have $10,000 a month coming into your business account in order for them to award you a line of credit. What happens is if you had $10,000 come in, it has to be like for 3 months, $10,000 coming in for 3 months. So if you get that card and then they do their audit and they look at your checking account, your business checking account, and your business checking account start dwindling, you don't have the $10,000 residually coming in. Say you may have $5,000 one month, $6,000, then $10,000. They'll start lowering your limits off of that too. The fintech company do. That's how they secure their sales with a fintech company because they don't have a personal guarantee. They didn't look at your personal credit. You know what I mean? So just be careful when you have a fintech company. Anyways, another potential is going to be when you use your credit card to buy real estate is that your credit score will likely drop. We all, especially if you're buying on a personal level, on the business side, we don't really care about your credit score dropping because business side, we know that the most important part is going to be utilization and payment history. New accounts do not affect your business credit. On a personal level, though, if you open up a new account or close a new account, your credit score is going to drop dramatically. And I mean, like 100 points or so, depending on the type of loan that you get. So, of course, when you take $100,000 out on a credit card, your utilization is going to shoot up, right? So now your utilization went from zero to maybe, even though you may have $1 million, your utilization went from zero to maybe 13%. Just because you went from zero to 13% that fast, your credit score tanks. It happened to me before. Like I used my personal line of credit to purchase a property. Um, and because my utilization was like at 3% at that time, and it jumped from 3% automatic, it go Jose and Rochelle right there. You had asked about them. But yeah, my personal line of credit jumped from like 3% up to 13% in 1 month. My credit score dropped, even though I was under 30%. It's just that it increased too fast. So just know that when you use your credit card to your credit score is going to drop. Again, it does go back down as you make your payment history. again, it's a new count. To them, it's their utilization just jumped dramatically. They don't really look at it as a new account, but just your utilization jumped up. Another thing is that if you're buying a property on your personal side and not your business side, again, these two are basically based off people that's buying properties, getting started in real estate, the low investors buying properties in their personal name. Your debt to income ratio is going to increase, right? So, of course, your credit card payment will rise, your debt to income ratio, and a high debt to income ratio may impact your ability to secure other finances in the future, especially with credit cards. I'm pretty sure we know how to, when we get denied for a credit card or can get denied for a credit line increase, we teach you in our program how to go back to that credit card company and get that awarded to you anyways. However, most people on the consumer level, you'll get a form and it'll tell you, first thing it'll tell you not enough payments or your utilization, your debt is not paid down enough. They give you a list of different reasons of why they denied you for your credit line, right? Most consumers, not knowing we know in this program, they'll just take that letter or just say I got denied and walk away. However, we teach you how to get the reconsideration and actually get that line of credit established or get that increase awarded to you. Lastly is that potentially you're going to pay more interest, unless you're taking advantage of the no or low interest rates. Your credit card will likely carry a higher credit limit than a mortgage. But again, there's a big difference on simple interest and amortized interest. You just have to know the difference when you're dealing with your credit cards. Again, it's all about being comfortable with being uncomfortable, right? But again, a lot of times credit card, people share 23%, they freak out, 25% on a consumer mindset, they freak out because 25% on a credit card seems high. However, it's based off the annual APR and the credit limit that you hold every month. So, we teach you, you know these things, those are in the program, you already know these things and how to go around those to make sure you keep your average daily balance dropping lower and lower and lower so you pay less in interest until the actual point that credit card is paid off. When a credit card is paid off, guess what? We don't pay. Zero balance, zero payment, so anyways, what to consider before using a credit card, before investing in real estate. We all know to invest in real estate, you need high limit credit cards, right? So, the biggest potential hurdle to overcome is that you'll need a credit line that's high enough to support the purchase, the down payment, or renovations. Consumers have an average credit limit of $22,600 spread across 4 credit cards. That's on the consumer level. So, that's why this program is so important to me, because I believe we're teaching you how to not only not to be a consumer, but how to be an investor, how to be a business, how to set yourself up as a business. So you're not getting those, 22K is the lowest limit that we normally get on a credit card. This is 22K that people have spread out between 4 cards. We get 22K or more on 1 card. So we're trying to teach you, how important it is to get these high limits and set yourself up to look financially sexy to the banks in order for you to build your financial future, right? With real estate, it's very important that you follow the steps in the program. Make sure you're leveraging yourself correctly. Make sure you're building your credit profile. And these things will come into play. You're not getting $10,000. How many people went and got the Navy Fed credit card and got 25K off the top from the stuff that we taught you in the program? So I know it's more and more. There's not a lot of people on the call right now, but I know there's plenty of people on the call that set up and did the steps that we taught them in our program, and they got a 25K Navy Federal card right off the top. That's not 4 cards, but 1 card. And then, of course, as you get more and more building your business credit, I think several people last week got $50,000. I know I got 100K line of credit last week. I got 100K line of credit card. So, again, as you build your stuff up and build your credit profile and utilize the steps that we teach you in this program, I mean, again, there's nothing stopping you. I can go take one credit card to go buy a $50,000 property, still put $20,000 in rehab, and I'm good. So, and I'm still not even really over my limit yet. So that's what I just wanted to talk about, the pros and cons of using the credit card, how to make sure you're comfortable with being uncomfortable, and make sure, you're following the steps of in the program. Not only that, make sure that when you get these credit cards, you're not utilizing them as a consumer. You have to utilize them as an investor. You know, I always tell. I have my credit cards set up for this card right here. I started setting my cards up by investments. This card is to buy a property. This card is do a rehab. This card is do a, you know what I mean? So all my cards are laid out in this stack as for what their purpose is. So I'll know, take this card off the top to buy this property, this card to do the rehab, blah, blah, blah. So, just make sure that you know your system, understand, the goal is to buy property to make passive and generational income, and to use your credit, not as a consumer, but to use your credit to make you income, right? All right, so that's all I have here. We all know that you know we're big on doing our case studies. So tonight, this case study is going to be a little bit more harder than we normally do, but please entertain me for everybody that's on the call and see if we can figure it out this together. All right. So we have a person that have an income of $6,200. Their mortgage is $2,450. They have household expenses of $1,200. That's including food, all the other stuff that they have, life insurance policies, all that stuff is all household expenses outside of their mortgage. They have a car payment number one for $500 with a remaining balance of $10,500. They have credit card one with a balance of $5,000 with a limit of $15K. Credit card two, balance of $3,000, a limit of $15K. Then they have a HELOC with $25K on it and a limit of $55K. And then they have a savings of $6,000. And they have also been on their job for a while. They have a 401K retirement account. Michael gonna love that with $120,000 in there. So let's break this down. How can we help this person not only create cash flow, but start using this money to create generational wealth? Anybody want to take a stab at it first? Let's do this. Tell me how much lines of credit they actually have. Let's start with there then.
30. 85,000.
85,000. Tell us how you get the 85,000, please.
Credit card 1, 2, and the HELOC.
So they have credit card 1, 2, and plus the HELOC. The HELOC, it has a limit of $55K. All right. So you want to take a shot at this, Raquel, since you started? Or Brian, anybody? I saw Brian unmute himself too.
6.
Yeah, I was gonna say, if you're willing to take that risk and pay the taxes, you can take some of that 401K and clear that HELOC. Since you got a balance of 25, that's about half. So that's more than that 30% of that HELOC.
So I'm gonna tell y'all a little secret here. In 2001, after COVID happened, all 401Ks and financial advisors that hold people investment accounts, you can do what is called a hardship withdrawal. A hardship withdrawal, you don't have to pay the taxes or the penalty for taking out that money. However, you do have to pay your federal taxes or state taxes on the money that you withdraw. So you can do a hardship with a withdrawal and just pay the taxes. Normally they take 10%, I think it is. Now you can pay more, but they'll take a minimum of 10% to go towards your federal taxes. They don't pay your state unless you elect to pay your state. Because some people don't have state taxes that they have to pay. I know Tennessee, when we live in Tennessee, we don't have a state tax. Here, we have a state tax. But when we live in Tennessee, we didn't have to pay state taxes, federal taxes. So you know, if you stay in a state that you do have to pay state taxes, you can do a hardship withdrawal. But you're right, Brian, that would probably be my first step that I would do. The reason why I would do that is because I would clear up everything on the board
Mm-hmm.
by with doing a hardship withdrawal and pay my little federal and state taxes. I will clear up everything on the board. So right now, before we go to that though, can somebody tell me what is their current cash flow monthly?
Oh, wait a minute.
And tell us how you do it. Go ahead.
2550.
1,217.
And tell us how you got that, Michael. I'm sorry.
I actually got 2050. So you get the income, you minus your mortgage, you minus your household expense, and you minus the car payment.
You're missing two more debts.
Two more debts.
Oh, I didn't put the credit card balances. I didn't put the credit card
Yeah.
payments on there. Sorry. So yeah, let's say the credit card payments are $100 a piece. So $200 extra. I'm sorry, I didn't realize I missed that, y'all. So now what their cash flow is, adding extra $200 to that debt.
1850. Yeah.
Yep, 1850. Does that make sense to everybody?
Yes.
And I didn't realize I didn't put the payment on the HELOC either. I'm slipping
Yeah,
today.
that's not there either. Yeah.
Let's just say the HELOC is going to be $500 a day. $500 because it's $500. So we went from 1850 at minus 500.
1,350.
1350. I'm sorry, y'all. I'm really
No,
slipping.
sir.
I'm sorry. So now we have 1350 cash flow. So again, we took the income minus all the monthly expenses. The savings account and retirement account don't really count to us. We're looking at the monthly expenses. So now they have a cash flow of 1350. And now we go back to Brian's way. Brian said that he will liquidate as the 401k. How much of that 401k? So let's add up the expenses. What expenses will we add up to figure out how much we need to take away from the 401k with the hardship withdrawal?
$43,500.
Okay.
If you do the car, credit card 1 and 2, and the HELOC,
And the HELOC. Okay. So
I think 5-3.
So with that method, so you clear all that. How much was it?
I'm double checking. 8, 18. I said 43.5.
Okay, 43.5. So minus the one. So say you're gonna have to probably take out 50K to cover your taxes and all that stuff, to transfer money and all that stuff like that. Maybe a little bit more. I mean, maybe a little bit less. I'm just jumping off the top of my head. So 50K coming out of your 120 leaves you with a balance of what?
$70,000.
Okay. What do I call the 401k? Anybody tell me what I call for the 401ks? Nobody. I call 401ks poor man's poor mentality savings account. People that don't know how to invest, people that just rely on somebody doing their investment for them. So what you just did by doing that, you just actually start investing in yourself. You took 50K off of that, your poor mentality account, savings account, and paid off your debts. What did that do for your cash flow, your monthly cash flow, by doing that? Anybody?
It increased your cash flow.
Yeah, it's gonna get a boost. Trying to calculate.
Yep. So increase your cash flow by what?
$700? Oh, more than that.
More than that. We had $500 payment on the HELOC. We had $100 payment on credit card.
$1,200.
And then yeah, so they increased their net cash flow back by $1,200. So they went from 1350 to plus 1,200. How much is it?
$25.50.
So they went from $13.50 to $25.50 a month just by doing that method. Does that make sense? Now,
Yeah.
did it hurt their savings?
No.
What did that do for their credit lines? They cleared their credit lines. Guess what they have now? They have free credit lines to invest, right?
Absolutely.
Yep.
I mean, everybody can see that situation here.
Yes.
All right, just want to make sure. Now, normally I would tell you to utilize your credit card to make sure you get your reward points and to pay off those credit cards to invest and pay off the car, right? You know, the steps that we do on the easier level. But because I put the mix in the 401k, because I wanted to make sure that I spoke about the poor mentality savings account, you know, I mean, the 401ks and stuff like that. Now, I'm not going to say all of them are like that because some people do have what are called self-directing IRAs, and they do that for to avoid paying taxes because there are certain things like real estate and mortgage notes that we do. You can actually use the self-directing IRA on a personal level to avoid the tax obligation or to go around using the 1031. So there are people that are smart investors that utilize those things, you know what I mean, for that. But most times people that have a job or whatever like that, that don't have a investment mindset, they just know that their job matches, oh, my job matches 6%, you know, whatever, up to 6%. They utilize that, but they use it as a savings account. Because most time what's going to happen, even though they had that 120K sitting in that account, say they're retiring tomorrow and they had that 120 in there. First thing they would have did was maybe paid off all those cards, right? And all the debts that they had, then take a vacation. Now that money is gone. They don't know anything about utilizing those credit cards for investments. They don't know anything about using that HELOC to purchase a property or anything like that. So they're still stuck in a continuous rat race. And more than likely, once that money is gone, they're going to end up ballooning those debts all over again, you know. So just keep that in mind as we continuously grow and think about our investment strategies and think about yourself as an investor, as business. How do you utilize your lines of credit? How do you use your money wisely, especially those that's having savings? Right, Raheem, you know what I say his name? Having that cash sitting to the side, you know what I mean? So just make sure you know how to utilize your money. Again, I always say it makes no sense to having money sitting to the side when you have outstanding debt. Invest in yourself. Utilize your money wisely so that you can clear up that cash flow to create passive income. So now we have 25.50. Now I have 4 minutes. We have 25.50 a month. We have 85K in lines of credit and $6,000 in savings. We're not even now the 401k not even thought about no more, guys. We're not even thinking about the 401k because now we don't took the money out. We don't cleared up our debt. That money's now is going to that 70K that's still in there is going to continuously start building itself back up into investments. Hopefully, the stock market and the markets go up so that you can start making money again. I think everybody's kind of negative right now on the year to date, but so now the 401k is out of our picture. What would you recommend somebody to do with those lines of credit and HELOCs? What would you recommend? Coach Raquel.
Uh-uh. Thinking since he or she or whatever has $25.50 a month, that's the mortgage payment every month. So you could make a principal payment every month on top of your regular payment on your mortgage. And then with the 85K, I'd buy an investment property.
Anybody else? That's good. I like that. Anybody else want to give a shot? So
Yeah, I was gonna say, I don't know if it was mentioned, pay off the car.
the car is already paid off. We paid the car off when we took the money from
Okay.
yeah.
Okay.
Yeah, the car is paid off. They already have free and clear car. They already have everything like that. I like Raquel's I like her mindset, but what I would have did with Raquel, I would have actually utilized my line of credit I would actually ask for credit line increases and probably apply for multiple more cards, 3 or 4 more cards to increase my credit lines, right? But then I would use 30% of my lines of credit to actually drop on the principal only on my mortgage. Why do I do that? Why do we drop principal money on principal only on your mortgage?
It destroys that interest.
It destroys the interest payment that the banks are going to get from you. So
Right.
now you're utilizing your money wisely. If I just paid an extra 24.50 on top of that, I still have interest I'm going to pay.
Interest, right.
But when I drop, what is 30% of 85 is what? So every time I drop 25.5 down on that, I kill the game. I kill the interest. I become what is known like a deadbeat dad. I become a deadbeat borrower to the banks because they're not making money off of me, right? So I'll continuously do that. And then my net cash flow was 24.5. That was my net cash flow, right?
25.50. So about 10
25.50. I'm
payments.
sorry, I'm saying it back. 25.50. So 25.50. How many months does it take me to pay back 25.5?
10 months
10 months.
or a little less than 10 months. Mhm.
I mean, you're about 10 months, right? So in 10 months, I'll pay that and I'll rinse and repeat every 10 months and using the same strategy. Hopefully, I'm increasing my net cash flow. I'm getting jobs. My job is, giving my annual whatever. I'm getting bonuses and those type of things if you're working or your business is generating more income and you're growing and growing and growing, right? So, and that way I can continue. The more income I have, the more cash flow I have, the more I can pay off that line of credit back. But every 10 months, just say randomly, I'm dropping 25.5 down and repeating the process. I still have, I only use 30%. I still going to be asking for my credit line increases every 3 months. And I'm updating my income every 9 months as we teach you in the program. So that means that I'm still going to be growing in between that time, right? My credit lines are still going to be growing in that time. So as I'm doing that, I can pay down that principal balance and save myself at the same time paying hundreds of $1,000s in interest. Correct.
Facts.
All right.
Like it.
So who before we leave here, somebody tell me what a truth in lending statement is. Anybody? Anybody? You can Google it. Truth in lending.
Is the truth in lending statement what creditors and including banks need to abide by and to make sure that they're practicing legal credit or borrowing or lending practices to consumers?
Yep, sort of. Go ahead. Yep. All right. I can agree with that. Anybody else?
Doesn't it say something like the lender has to disclose all kinds of fees and charges that they're gonna bill you or charge you for your loan?
Correct. So a truth in lending statement is just basically a disclosure saying how much you're gonna be charged in interest and fees. So the borrower has to be aware of what they're gonna be paying in interest on a loan, right?
Uh-huh.
That's the paper you're signing. Most people that sign a mortgage never really pay attention. They're just happy to get the home, right? So a lot of people just happy to get a car. They're just happy to get the student loan to go to school. Their excitement makes them avoid looking at the truth in lending statement. This is why it's very important in our program that you understand about velocity banking, because even though I'm looking at that truth in lending statement, I'm saying to them, yeah, right, you're not getting that interest on me. So um let's look at this one real fast. So let's see if it lets me do it. I don't know. I don't know what happened here. Let's see. Trying to get my calculator to work. It's not. That's definitely not right. I'm not sure why it's not doing it. Am I missing something here? Can somebody help me out here? What am I missing? It's not giving my interest that I'm gonna pay. Why is my interest doing that? You see my interest payments missing? Oh, never mind. I see it here. Sorry, I'm tripping. So this is gonna be my truth in lending statement, right? This is definitely not right. Oh, I see what I did.
Loan period is incorrect.
I'm sorry, my loans, like my loans are. So this is a 30-year mortgage that most people would take, right? Um, so they bought property for 120 at a 5% interest rate on a 30-year. This is basically what your truth in lending statement is going to look like. It's going to tell you these up here, the terms, and then it's going to tell you your monthly payment, how many payments you're going to make, and then the total interest that you're going to pay. Look how much they're going to pay interest on a 30-year mortgage at 5 years.
Close to double.
Close to almost double what their principal balance is. Again, most people don't pay attention to their truth in lending statement. That's why it's very important in this program that you know what a truth in lending statement is. So even though I'm getting this and I'm looking at it, your mind's like, yeah, right. I'm going to Velocity Bank this loan back. You ain't going to make none of that off me. So just take the 25, say we're going to take the same 25.5 and drop it on principal only, like we said. Look what it does to that interest. Just the 25.5. Look how much it took that interest down to half.
Wow.
10 months later, on the 11th month, I drop another 25.5 down. This is what they're gonna get in interest. I went all the way from 111,000 to only 24,000 in just 11 months. And I rinse and repeat the whole process until that mortgage is paid off. We all see that?
Yes.
All right. So, and then another 11 months, that's going to be 21. No, sorry. Now we went down to 12. And then the mortgage is, now we went down to 12K that they're going to make up on a 30-year mortgage. The power of knowing the truth in lending statement, the power of Velocity Banking, the power of what we teach in this program. Right?
Yeah,
anyway.
you know they're gonna sell that loan after that second payment, if not the first.
They're gonna get rid of that thing.
About it.
You're a deadbeat, man. They went from almost making 100,000, 111,000 off you, double what your principal was, to making only 12K. You become a deadbeat borrower to them. And if you're really sexy and you continuously do it all the way till the mortgage paid off, you probably end up paying nothing. Because I think the next one is going to be 21. What would that be? 30? I'm just going to drop it down here somewhere. Yeah, I do another 25.5 on that last payment. This is how much they're really going to get off of you. Not almost $8,500 on a 30-year mortgage. And then that mortgage is paid off in 40, what is that? 41 months, 41 months. 41 months. Your mortgage is paid off on a 30-year mortgage.
So, boy.
Yes, ma'am.
What type of person or investor buys that note, though? Like Brian said, they're probably going to sell your note. But who's going to buy it knowing that you're paying that debt down that fast?
That's going to be up to them. That's going to be another bank. I mean, us as an investor, again, we are investors, right? We know how to utilize our money, right? But most consumers not going to do what we're doing, Raquel.
Mm-hmm.
So they'll be just making those monthly payments just to make sure they got their mortgage paid and still living month to month and paying all that interest. But I mean, but as far as an investor, most investors are not going to probably buy that note. I wouldn't definitely buy that note. I would be happy to see them put that 25.5 down on the down payment. I'm like, oh, they got equity in the property. But once I start seeing them making them big payments, I mean, I guess you could say I'm getting my money back faster, my principal money, so I can reinvest it, but I'm not making any money off that person. Again, I'm a deadbeat borrower. Same thing with a credit card. If I go take a credit card and I run up $10,000 and I turn around and I pay that $10,000 off that next month, the credit card company don't make money off me. I'm a deadbeat borrower. They're waiting for people to actually hold and have balances. That's why there's only certain credit card companies that do what are called charge cards, because with a charge card, you supposedly pay it off every month. You know what I mean? But now charge cards are becoming um, uh, pay by balance. So you know, you have the option to pay the balance over time like a regular credit card, because a charge card, they're not getting any money off you besides the annual fee, right?
So, boy, what's okay, so you know how, like you said, they start taking you after a while, you build a relationship with the bank and you're paying off these things. You have money coming in and you're paying off loans, with the velocity banking, they start, taking you into the back room. They know you by name. When they go to extend a loan to you, I mean, they know because of your banking history that they're not going to make any money off you. If I go to Navy Fed and I take out a $50,000 loan for a mortgage, and I pay the $50,000 off in 2 years or 3 years or 2 years, I mean, are you going to run into a situation where you're going to have to try to do business with another bank because you're constantly paying off these notes quickly?
No, so that when you're building your banking relationships along with your credit profile, what you're telling them is trustworthiness. They're not looking to get money off of you so much so as a credit card is. Banks, when you're going to them like that or building your banking relationship, even with the credit card, they're looking at your trustworthiness. Am I can give you this and be trust that you're going to be able to use this money wisely. You know what I mean? Even though they're not really going to make money off you. But a lot of times, honestly, they'll give you more and more lines of credit just so they can put you in a trap. The goal is to hopefully that you carry a balance, and you know what I mean, one day, or so they can start making money off of you. So again, that's why banks award people stuff. So the more they award you, the more they're trying to get you in a trap. This is like somebody, my homeboy, he filed bankruptcy. He's like, man, I ain't gonna be able to get no credit cards and all that stuff like that. I said, what kind of chapter you file? He said, I filed 7. I said, oh, your credit is clear. They're gonna begin to give you offers everywhere. As soon as I said that, he called me next week. He said, man, I got like 4 credit card offers. I said, yeah, because your credit cleared. That now their goal is to put you back in the trap. So that's why they do that, though. Just but what we're doing is building trustworthiness, Raquel.
Gotcha.
Isn't that's kind of just the same as like, with your credit karmas and stuff, like when you when you've paid off, if you pay off like big balances sometimes too fast, sometimes it'll cause your credit score to tank a little bit.
Yeah, some people tell you to pay off credit cards every month down to 0. I mean, it's all right to actually hold a balance sometimes, so that way you can show that you can hold a balance. You don't have to have a big balance, but yeah, you're right. Yeah, I don't know, man. I think to me, with the banks, it's more about credit worthiness, and then building that working relationship, saying that I am worthy of your funds. Because I'm telling y'all, Wells Fargo, and I'm saying it's recorded. Wells Fargo, Bank of America, Citi, PNC Bank, all those bigger banks, they're not lending to minorities. They'll have minorities work for them, but it's going to be very, very hard for you to even get a personal line. Hey, go to one of the banks and ask for a personal line of credit with a 720 something credit score. It's going to be hard because they don't lend to us because they have a lending criteria. We're already locked out from them. So you're going to have to get the Navy Federals and the smaller banks and those type of people that's going to actually lend to us. But then you're still going to have to go through a criteria to get qualified. Why would I want to do that to myself and set myself up? And every time, say I get a loan and I pay that loan off, I have to go back and apply for another loan and do the whole process. So getting a loan can be stressful. Not only that, it feel like you're being attacked and beat up, or I need more paycheck stuff. This, I need that. I need your W-2 taxes. I don't have to do all that stuff with a credit card. And not only that, for those that know, in our program, we teach us credit card is what? Is what stated what?
Revolving credit.
No, no. Stated when I apply for a line of credit, it's stated what? Income. I don't have to prove anything. All I have to do is tell you what I make. It's stated income. So that's another reason why we get high lines of credit, because we teach you what stated income is. You know what I mean? So again, these banks, again, your job is the only, especially for us in this program, your job for your bank is to not only you build your banking relationship by sending that money in and out and show them that you know how to utilize your money wisely, but you're looking for the perks and rewards that your banks offer, such as mortgages, especially if you're on the personal side and you're looking for a primary residence. You know what I mean? They see the way you utilize your money, they see the type of income that you have coming in. Those things help you get qualified for a primary mortgage, even if you wanted to use an investment mortgage. Again, Navy Fed have one primary mortgage you can have and 4 investment mortgages. That's dope for a lot of people. That's how I got started, by utilizing my mortgages. But then I start switching over to my credit cards. But again, every mortgage that I had to apply for, I had to apply for. They're going through your DTI, they're going through your debts, they're going through your collection, they're going through your personal life, they're going through everything. So it makes it harder. But when I started utilizing credit cards, it made it more easier for me to buy the properties. I just had to be comfortable with being uncomfortable until that property start cash flowing.
Hey, yeah, Sabor, and to follow up on that, especially a few months ago when the nationwide real estate market was super hot, having to wait for, to go through all that underwriting with the banks to get a loan on properties was causing some people to lose out when, like you pretty much a cash buyer, a strong cash buyer when you got high lines of credit.
Mm-hmm. Yeah, they ask you even when we go do our investment properties, right? Everybody in the investment group that's on the call, y'all seen it when we go apply for put our offer in on a property. The first thing they're going to ask you is this going to be a cash offer or financing? Even though I'm coming in 25% under their asking price, because I'm coming in with cash and not financing, they're willing to accept that offer. If somebody doing financing, it takes them longer, maybe 30 days to 45 days, or even longer to close. I know one dude said that he was actually just closing 60 days later after even getting pre-qualified. He has to have to wait 60 days to close. So, but with a cash offer, credit card is basically considered a cash offer. So and those that don't know, when you go apply for put in an offer on your properties, they're going to ask you, is it going to be cash offer or refinance? If you're using a credit card, just say cash offer. It's already in there. All right. Anybody got anything else? I'm getting off the call because I have to do a walk in the morning for my granddaughter. We gotta be up at 7, be down there at 7.
All right, thank you so much for your time.
Thank you so much.
You too.
There you
Michael, we
go.
look forward to hearing from you next week, man. You better be ready. He said he got a PowerPoint for us, guys.
Yeah,
I'll make sure
got you.
I'm a pump on the Facebook pages and then our social media pages that you are going to be speaking next week, so we actually have more people. Okay, I'll pump all week long for you.
Thank you so much. Appreciate it.
All right,
Have a good
y'all.
night,
Have
everyone.
Hey,
y'all-
Have a
Sabor.
good week, everyone.
Night.
Hey,
I see you Tuesday, Keisha.
hey, Sabor.
See you Tuesday.
Yes, sir.
No, I was just gonna ask, when the next investor meeting, I guess.
You know what? I've been so busy this week. I thought about it. I said, man, we normally have it after the call, but Renee been working doubles, so I'm actually waiting for her to clear up. We close on the
Okay.
property. Yeah, we close on the property. I sent them all a message. I'm sorry. I sent them all an email, so we communicated through email this week because we were still waiting on the recording information on the property. And
Right.
I didn't even think about setting down, but Renee's working. But I'll say Tuesday after Tuesday night, I'll try to schedule something Monday. I'm gonna hit everybody up and see what their availability is.
Okay. What's I guess what's the status on the new property, the investment property?
Oh,
Any
it's sold. It's sold. The guy closed now. We got the recording. We're just waiting on the recording information. The servicing company already picked up the servicing, already sent him out the coupon booklet. So his first payment is going to be November the 1st. So everything's set up though. We're just waiting on the recording information because the servicing company needs to have that recording information on file.
cool. Now I was talking about as far as finding the next one, finding the next
Oh,
property.
man, I put so many offers in, man. It's been ridiculous, man. I've been putting so many offers in. got a couple of offers accepted. Again, I told you about the guy. He's asking too much. He just bought the property at 43 and he's trying to sell it for 80. And I told him I'm not paying 80K, and he only had it for 5 months unless he showed me proof of a rehab. He sent me some janky pictures that didn't even look like a full rehab, like just threw some paint over trash. I'm like, we're not doing that one. So I put in a couple other offers this week and just waiting to hear back from the seller.
Yeah, following up from our talk earlier,